February 2020. Thomas has 80,000 euros in VWCE, a broad global ETF. The market starts dropping, down 10%, down 20%, down 34% in 33 days. Every financial news channel says the same thing. Get out, cut losses, protect what you have. Thomas sells every unit at minus 34%. 12 months later, the market has recovered 120%. Thomas's 80,000 euros, if he had held, would be worth approximately 106,000 euros. Instead, it is 52,800 euros, still sitting in cash, waiting to feel safe again. Thomas did not lose money because the market crashed. He lost money because of something that happened inside his brain before he clicked sell. This is what NTM told us, the technical layer behind the philosophy. Today, the psychology behind Thomas's decision, the 4 ways it shows up in your portfolio, and the framework to fight it. In 1979, psychologists Daniel Kahneman and Amos Tversky published a paper that would eventually win the Nobel Prize in economics. It was called prospect theory. The finding: losses feel approximately twice as painful as equivalent gains feel pleasurable. Losing 100 euros hurts roughly twice as much as gaining 100 euros feels good. The mathematics of your portfolio are symmetrical. The psychology of your portfolio is not. This is loss aversion, and it is not a character flaw. It is a survival mechanism. For most of human history, losing resources was potentially fatal. A brain that responded twice as hard to loss as to gain was more likely to survive. Evolution rewarded this response. The problem: your brain cannot distinguish between losing a food supply to a predator and watching your ETF portfolio drop 34% on a screen. Both trigger the same ancient response. Get out. Protect what remains. Stop the bleeding. The market is not a predator, but your amygdala does not know that. The 4 manifestations. Manifestation 1. Selling in crashes. Thomas's story. Thomas's story is not unusual. According to DALBAR research, the most comprehensive annual study of investor behavior, the average equity fund investor underperforms the index by approximately 4% per year. Not because they picked bad funds, because they sold during drops and bought during rallies. In March 2020, Thomas was not alone. Billions of euros of ETF assets were sold at or near the market bottom across Europe. The investors who held, who did nothing, captured the full 120% recovery. The investors who sold captured none of it. Loss aversion explains why. The pain of watching 80,000 euros become 52,800 euros was unbearable. Selling stopped the visible pain. It also stopped the recovery. On Nobody Told Mike, Mike Petrie has talked about what it feels like to watch a portfolio drop by a third. The instinct to act, the feeling that doing nothing is reckless, but doing nothing is precisely what the data supports. According to JP Morgan Asset Management Research, covered in episode 9 of What NTM Told Us, missing just the 10 best trading days in the S&P 500 over 20 years reduces returns by more than 50%. Most of those 10 best days occur within weeks of the 10 worst. Investors who sold during the crash miss them entirely. Loss aversion does not protect your portfolio during a crash. It locks in the loss and removes you from the recovery. Manifestation 2. Holding losers. Too long, Sara's break-even trap. Sara bought a technology ETF at 120 euros per unit. It dropped to 80 euros. She has lost 33%. The rational question, given what I know today, is this the best place for this money? If the answer is no, sell and redeploy. The loss aversion question, but if I sell at 80 euros, I have actually lost the 40 euros. If I hold, maybe it comes back to 120 euros, and I have not really lost anything. This is the break-even effect, a specific form of loss aversion documented by Kahneman and Tversky. The pain of crystallizing the loss feels worse than the rational calculation suggests it should be. So investors hold losing positions for months, sometimes years, waiting to get back to break even. The cost, the capital is trapped in an underperforming position, instead of being redeployed into a better one. The loss already happened. It happened the day the price dropped. Selling does not create the loss. It only makes it visible. Sara held her technology ETF for 22 additional months, waiting for break-even. The position returned to 100 euros, still below her entry price. She finally sold. Meanwhile, VWCE returned approximately 35% in the same period. Her loss aversion cost her the difference between minus 17% and plus 35%, a gap of over 50 percentage points on the same capital over the same time. If you have ever held a position longer than you should have to avoid admitting a loss, this episode was made for you. Hit like and keep watching. Manifestation 3. Staying in cash, Elena's hidden loss. Aversion, Elena keeps 40,000 euros in a savings account. It never goes down, she says. It is safe. Covered in episode 10 of What NTM Told Us, The Money Illusion. The number on the screen never drops. So the brain registers no loss. The purchasing power drops by 6% per year during high inflation. But that loss is invisible, gradual, and never triggers the loss aversion response. This is loss aversion in disguise. Elena is not avoiding risk, she is avoiding visible loss. The invisible loss, inflation slowly eroding her 40,000 euros to the equivalent of 31,000 euros in real purchasing power over 4 years, does not feel like a loss because it never appears on a screen. On Nobody Told Mike, Mike Petrie calls this the safety trap. The thing that feels safest is not always the thing that is safest. Sometimes it is the thing that hides the damage best. The savings account is not protecting Elena from loss. It is protecting her from the feeling of loss. The loss is happening anyway. Mike's framework. Mike Petrie has built Nobody Told Mike around one core observation. The most expensive financial decisions most people make are not driven by bad analysis. They are driven by how loss feels. Every episode on Nobody Told Mike and every breakdown on What NTM Told Us is at some level a loss aversion story. The savings account that feels safe while inflation eats it, episode 10. The house that feels like wealth while the transaction costs and opportunity cost accumulate, episode 12. The dividend payment that feels like income while the total return approach generates more, episode 13. The 1.8% fee that feels small while it compounds to 232,000 euros, episode 14. The delay that feels cautious while the market runs without you. Episode 9. Loss aversion is not the enemy. It cannot be switched off. Kahneman spent his career studying it and admitted he still felt it himself. The framework that works is not elimination. It is recognition. When a financial decision feels driven by the fear of a visible loss rather than by the actual numbers, pause, run the math. Ask, is this the rational calculation, or is this my amygdala telling me to get out of the way of a predator that is not there? That is what Mike Petrie calls modern financial philosophy, not the highest returning strategy, the one that your loss-averse brain can actually stay in long enough for the returns to compound. Loss aversion is not a character flaw. It is a survival mechanism. It kept your ancestors alive. It is keeping your portfolio poor. The trick is knowing which problem you are solving. Here is the question for the comments. Which of these 3 manifestations have you experienced? Selling in a crash, holding losers too long, or staying in cash? Be honest. Drop it below. If this changed how you think about your own financial decisions, subscribe here for more NTM explainers, and watch Mike break down the full behavioral philosophy across multiple episodes on Nobody Told Mike. The link is below.